The average credit card interest rate is over 20%, but a balance transfer card can get you 0% for up to 21 months. So let's talk all about it. Hello and welcome back to my channel. My name is Layla and I talk about all things personal finance. For this video, I'm going to be talking all about balance transfers, which is a type of debt consolidation, but I do have a whole video talking about debt consolidation in general. That will be linked down below. But in this video, I'm going to cover what a balance transfer is, who will benefit the most from a balance transfer versus who may not benefit from a balance transfer, and I'll also share some helpful tips. A balance transfer is moving existing debt, typically credit card debt, to a new card with a lower, oftentimes 0% interest rate for a set period of time. This is known as an introductory interest rate. Most often you'll see 0% offers for about 12 months or 18 months, 21 months. The longest I've seen is 24 months. And balance transfers can be a great tool when you're working on paying down your debt, because they will save you money in interest. And as always, I do like to give examples. So let's say that you have a credit card that has a 26% interest rate and you owe about $5,000 on that card. So you go search for a new credit card, specifically one for a balance transfer, and you find one, you apply for it, you get approved. It has a 0% interest rate for 18 months. So now you use that new credit card to pay for that $5,000 debt on the past credit card. So now that $5,000 debt is on this new card. You're going to have a new minimum payment. You'll be paying 0% interest for 18 months. And after that 18-month period, your interest rate will likely skyrocket. It's going to go from 0% to probably 25% plus. So the goal is to try to pay the full $5,000 down within 18 months. And of course, that old credit card that had the $5,000, you were able to transfer the whole amount, so that card is at $0. Balance transfer cards do typically come with a fee, anywhere from 3 to 5%. It is ideal to find a card with a lower balance transfer fee, and we'll talk about this more because we want to make sure we're actually saving money, and if that balance transfer fee is high versus what you would be saving by actually making the transfer, it may not be worth it. But we'll talk about that. But I did want to call out that that fee does get tacked on to your balance. Those with high interest debt. So most often this is going to be like credit card debt, but even sometimes personal loans have pretty high interest rates. It's really up to you to decide what you consider high interest and what would be worth it when considering a balance transfer. In general, I often say that anything above 8% is high interest, but just because you have a debt that's, 8%, 9%, 10%, it doesn't mean it's best to do a balance transfer because of that fee. So depending on how much you end up transferring, what you have to pay in the fee doesn't balance out what it would be saving you by getting that 0%. But if you have a personal loan or credit cards that are above, 15%, 20%, above 25%, even going down to 0% for 18 months, 21 months is definitely going to save you money. Balance transfers are also going to be best for people who can qualify for a good offer. So you would need a good credit score. Depending on the cards that you have and the accounts that you have open, you may receive offers in the mail or that come to your email. And those are often going to be the best options for you because you're already an established customer with those banks. So sometimes they'll send you pre-approvals for a balance transfer offer, and those are often a great place to start. Otherwise, a quick Google search can be really helpful in seeing if you can find a card that works with your credit score. So if you just go to Google, type in best balance transfer cards, go to NerdWallet or Experian. Those websites, they compile data of different cards, and they often have a range displayed of credit scores required to be approved for that credit card. Now, those ranges are not 100% accurate. You could have a credit score that falls within that range, but if you have a very high debt to income ratio, for example, you may find yourself being rejected. So just be careful of that, but that's a great way to see which cards may be a good fit for you. And with balance transfer cards, they're typically always going to be a 0% offer. It just depends on your credit score if you even get approved. Balance transfers are also good for individuals who have a solid plan to pay off that debt before the 0% offer ends. In order for you to benefit the most from a balance transfer, it would be ideal to pay off the whole amount that you transferred within that promo period. So if you had, $6,000 transferred and it's 0% for 18 months, then you would want to pay like about $333 on a monthly basis to make sure you pay that down before the interest skyrockets. Now, of course, once that 18 months is up, you could open another balance transfer card, but that's not something that's guaranteed. You know, maybe your situation is different. You're looking at getting a mortgage and you don't want to hit your credit whatsoever. So yeah, you just want to be careful about that and feel confident about being able to tackle that. Otherwise, you would risk an increased interest rate. Real quick, I want to share my experience with the balance transfer because when I was paying my debt down, I did do a balance transfer. I did it one time. I actually did it with a student loan, and it's not something I typically recommend, but at the time it felt like the right choice. And I was luckily able to pay that off within the promo period. I think I only had 12 months of a 0% interest rate, and I believe I did transfer about $6,000. However, that full 12 months, I was stressing out. Once I got a few months into the transfer, I was like, I'm not sure that I can completely pay this off before the interest kicks in. And for my situation, I transferred a student loan, which is something I typically don't recommend just because it's usually a lower interest rate. And yes, I was able to save money by getting it down to 0%, and I, did the math with the balance transfer fee and everything. But I knew that if I didn't pay it off, the interest rate after that promo period was going to be, 20%, 27%. I can't remember what it was at the time, but that really stressed me out. So be careful with that. That was my personal experience, and I think it's good for several situations, but if you have a solid plan to be able to tackle it, that's going to be much better. If you struggle with spending, consolidation, balance transfer fees may not be the best option for you, because what ends up happening, you open this credit card, yes, you get that 0%, it's 18 months, 21 months, great. Maybe you're even able to pay that off. But now you have this old credit card, there's a $0 balance, and for some people, they see that as an opportunity to spend more money. So now they have this balance transfer, it has $5,000 on it. This one, you end up racking up more debt, add another $5,000, $6,000, and you have $10,000 altogether. And then as you start paying down that balance transfer card, you make purchases and have even more debt. So just be really careful about it. You know yourself best. If you do end up doing a balance transfer and need to close out that card, then do so. At the very least, I would suggest freezing it. Sometimes closing your card is not the best option because that will ding your credit score. So just keep that in mind. But yeah, if you have a spending problem and you don't trust yourself to rack up more debt after the balance transfer, then maybe just don't do it at all. Also, if you don't feel confident that you can pay off the balance before the promo period ends, maybe best to hold off on this. And this really depends on the situation. If you're going from a 27% interest rate and you are able to get it down to 0% for 18 months, you're going to save money. Even if it skyrockets after that time period and it goes to 27% again, at least for 18 months, you had 0%. That is going to save you potentially hundreds, sometimes even thousands of dollars during that time. So it could still be worth it. If you're doing a transfer like I did, where it's a lower interest rate, and then you're worried about it getting much higher if you don't pay that off, then it may not be a good option for you. It does really depend on your situation, and that's why it's really important to run the numbers, see what's possible for you, and then make that decision. It also may not benefit you if the balance transfer fee cancels out the savings. So as I said before, the fee is typically 3 to 5%. Ideal if you can get 3%, but sometimes it's 5%. And if you're doing a larger transfer and maybe it's not as high of an interest rate from before, then you may not save as much money as you think if you factor in that balance transfer fee. So always do the math and then make the decision. And then of course, if you have a lower credit score, you may not be approved, and that could ding your credit score even further. If you are planning on taking out a mortgage or getting a car loan anytime soon, then just keep in mind that getting a new card, even if it is a balance transfer card, will impact your credit score, and just want to be careful of that depending on what you're trying to do with your finances. So first up would be find a card with a long 0% APR period. So if it's 15 months, 18 months, 21 months, that of course is going to benefit you more, 0% for a longer period of time. Do the math on however much you are considering transferring. Now it does depend on how much you get approved for. So when you apply for a credit card, you also get a credit limit. So sometimes that could be, $17,000 versus $6,000. It also depends how much debt that you have and how much you would want to transfer. Once you decide how much you will be transferring, do the math on the fee that you would be paying versus the savings on the interest and make sure it is worth it. Be sure to establish a payoff plan even before you consider the balance transfer. When you started tackling your debt, you should have a payoff plan in place. I have a couple of videos where I talk about this, choosing the avalanche versus the snowball, some things. Choose some sort of plan and stick with that. But once you introduce these balance transfers in, that could shift things around. So you want to reevaluate things and come up with a new plan. And if you do a balance transfer, make sure you try to pay that off within the 0% APR period. Like that example I said before, if you transfer over $6,000, you have 0% for 18 months. You want to pay $333 or so every single month to be able to pay that off during that period. Otherwise, your interest rate will hop up to, well over 20%. I would suggest avoiding new purchases on that balance transfer card. Things kind of get confusing. Any purchases on a balance transfer card aside from the transfer will have interest on those purchases. So if you start adding on purchases, things are gonna get more complicated. You're gonna get confused with things. If you make payments, it's gonna go toward those new purchases versus the balance transfers, and then it's gonna mess up your payoff plan. So I just would use that balance transfer card exactly what it's for, and then, just stop using credit cards altogether or use a different one if you are using them. Check your credit score before applying. And as I was talking about before, if you're looking at NerdWallet or Experian where they list those credit score ranges that you would likely get approved for, just pay attention to those. Not guaranteed, but a good rule of thumb to follow. And if you don't feel confident that you would get approved for a card, just be aware that you may be rejected and that's going to ding your credit score. So if you need to work on building that up first and then applying, that may be the best option. And then I kind of touched on this a bit before, but if you are doing a balance transfer of a credit card, that old credit card, you can close it out if you want to, but it's not something I always recommend doing just because that is going to lower your credit score. And I think sometimes people think that that card will automatically close if you do a balance transfer. That is not the case with credit cards. If you were to transfer over a student loan, yes, if you covered that whole student loan in the transfer, then that would be completely closed out. It's not like you can continue taking out on that same student loan, but with the credit card, you could keep adding on to that. So it doesn't automatically close out that card, and I don't recommend closing it unless you feel that you cannot responsibly keep a credit card. But yeah, if you actively have credit card debt, I just say don't use credit cards. Keep it somewhere where you're not going to touch it and tackle that debt. Then you can come back to using credit cards if you feel confident that you can use them responsibly. And you can technically keep on adding new cards and doing new balance transfers if that's the strategy you choose to take. I've known many people actually who have done this. But if it's not something that you feel comfortable with, or if you're having trouble getting approved for these cards, you do have other options. Keep working on building up that credit score by making on-time payments and just lowering your debt in general. Just follow your debt payoff plan. You can also call credit card companies and ask for a lower interest rate. You can see if they have any promos available to you. You're a loyal customer, you're working on improving your finances. This is something I ask all of my clients to do who have high interest credit card debt, because you can give it a shot. It's absolutely worth it to just make a phone call and see if something is available. And they may not offer you 0%. That's typically not what happens unless you open a balance transfer card. But if you can go from 25% down to even just like 14% or 17%, even if it's just temporary, like just for 6 months, you now have this interest rate, that's going to save you much more money than if you didn't take the chance at all. It is absolutely worth it to make a phone call. When I started my debt-free journey, that's what I did. At the time, I had like 5 or 6 different credit cards. I called everyone, asked for a lower interest rate, and all of them except for one did give me a lower interest rate. There are a number of factors that affect that decision if there's any offers out there, but even to this day, like in 2025, there are people that I work with and they still get these offers just by calling and asking. So yes, overall, I would say balance transfers are a great tool for tackling debt as long as you're doing it the right way. And the key thing to remember here is to run the numbers and make sure you have a solid plan before transferring any debt. Let me know if you have any questions on balance transfers. Also, if you have done a balance transfer before, I would love to hear your experience, whether that's something that's happening right now or you did it in the past. I would love to hear that. Thank you so much for watching. I would really appreciate if you give this video a thumbs up, subscribe if you haven't already, and I'll see you in my next one.